Welcome to Perspectives from HSBC. Thanks for joining us. And now, on to today's show.
Welcome to another episode of HSBC Perspectives. My name's Stephen Major, Global Head of Fixed Income Research.
And I'm Paul Mackel, Global Head of FX Research.
And we're here today to discuss bonds and currencies. A very exciting area, we think at least, and one that's given us quite some surprise so far in 2025. But by way of backdrop, Paul, I think we need to just reflect on where we were at the start of the year. Last time we were here in Hong Kong, actually, at the Asian Outlook, and what's happened since then. Certainly for the bond market, I think that there's been quite some turning upside down in people's expectations from the end of last year. Bonds in China and Europe have seen yields go into reverse from what they were doing through the second half of last year, and the US Treasury market has been rallying. That means the yields have been coming down. So in FX, what's been going on? The dollar's been going down this year.
Well, it's a great starting point for the conversation, but you're absolutely right. There's been a big sea change in thinking from the start of this year. Many people thought that the dollar was going to keep strengthening and strengthening and strengthening. But in the last month or so, there's been a reversal of fortune, so to speak. As you said, it's been struggling. And there's a few things behind it. I mean, the first, of course, is a lot of fatigue with trying to understand the U.S. administration's policies and what that could mean for the currency market, especially the dollar, so around about tariffs. The second thing comes down to big changes in Germany and how the market has perceived that. So the euro's done very well on the announcement of this big fiscal change. And of course, when you have the most actively traded currency pair move very quickly, that has a rippling effect across other exchange rates. But the other thing, which I think is relevant not only for me but yourself, is how markets have been thinking differently about the U.S. growth outlook. And that too has been weighing on the dollar most recently. But for you, how are you thinking that in the context of the Treasury market?
Well, look, you're right. The growth expectations have been starting to slip, and actually the Federal Reserve itself revised down its growth forecast this year. They revised those down by more than they revised the inflation forecast up, for example. So the bond market is taking this and thinking ahead, and that's why I think yields have been slipping. The Federal Reserve probably needs validation of the expectations that's coming through in the sentiment before they follow through. But I think bonds are rationally following this path for growth that is more downwards than it was in 2024.
But on that note, which growth numbers would you be looking out for this validation that Treasury yields can keep falling?
Well, yeah, we can see in real time what some of the surveys are saying.
Yes.
And of course, we don't really ever know until it's too late what the actual numbers were till afterwards. But I think already there's evidence in the sentiment and in the confidence numbers, and some of it is down to the policies, and you've seen what's going on, whereby they're looking at expenses at the federal level, and therefore confidence is going down. So I think that the fiscal position is very, very different to what people had expected coming into this year, and that may be part of the reason, Paul, that the yields have fallen. I have to ask you this question because it's front of mind for me. Is the surprise in Europe really the biggest surprise that you've seen?
It's a great question, and I mean, there's a number of surprises already in 2025. I mean, that's always the case every year in the currency market. But yes, I'd say what had happened in Germany, the magnitude and how quickly things had changed was the biggest surprise. I think that another surprise, of course, was just how elevated expectations were, how the Trump administration could be rolling out tariffs. And that's been happening, but not in the same way that it'd be lifting the dollar as many people had thought. But what about for you in terms of surprises this year?
Well, look, in my career, I'd say that the surprise in Europe is maybe one of the biggest. Now, just to be very clear, this is the fiscal surprise in Europe, right? So it's Germany borrowing money beyond what was ever expected and releasing the debt brake. That's the surprise. I think we can go back to the fall of the Berlin Wall to find a similar kind of scale anything of this magnitude. So it's enormous, and it's a bit like the US is transferring some of the fiscal risk that it had on its own economy over to Europe. And therefore you've seen a massive swing in the bond yields. Now, I suspect it's been overdone, Paul, and I think this. I don't know how this feeds into currencies, but for us, maybe the bond yield, the German bond yield, has gone up too quickly, and all of those yields in Europe have overreacted. Now, if that's the case, and they start sliding down again, it must have some FX implications.
Well, it certainly does. I mean, we were seeing some early indications of that the optimism around this story, again, in the currency market with the euro trading very well, it's starting to stabilize. Let's see how things develop over the next couple of months. But, just sticking with this point of view, more debt, what does that mean in the context of bond yields in your framework?
Well, you know from some of the work we've done in the past that I tend to think that more debt, therefore more bond supply, isn't really the reason for the yields to go higher. It's controversial, but I think we have to go beyond the intuition. What matters is what the central bank is thinking about the longer run growth and inflation, and therefore what it means for the equilibrium policy rate. What that policy rate is going to be 3 to 5 years hence. And so Germany may be taking on $500 billion, €1 trillion of extra debt over the next decade, who knows? But it's just Germany. That's not the whole of the Eurozone. Germany is only one country. So I think it's illogical that the yields have gone up by so much, and they've gone up so much elsewhere, in France, Italy, and Spain, for example. And also, I would say that in the case of Germany, this is the best credit. This is the one country that could afford to borrow some more. So if this was a corporate, it would be like Apple or Microsoft. People will be queuing up to grab those bonds. So I don't really think it is as big a problem for the bond markets in Europe as the market has currently thought.
And I have a lot of sympathy with that. But time will tell in the next few months whether the real data in Germany actually truly improves in contrast to some of the brightness in the survey data. But for Steve, in terms of thinking about the next couple of quarters, how are you looking at the bond market, especially the treasury market, and also Asia?
So look, the bond market is responding real time to what it thinks is going to happen in the next half of the year and through into 2026. And I think it's fair to say that the market expectations for the Fed rate cuts have varied between 0 and 7 cuts in the last 6 months. So if we were to say 3, it would be right in the middle of the 0 to 7 range. So I think second half of the year, the Fed's probably going to be back on that path they were on last September and take those policy rates back towards the 3% longer run equilibrium. That's our baseline.
And our baseline is, well, first we probably still have to brace for impact of more tariffs, and what that could be meaning in the currency market is it probably should be giving the dollar the upper hand, at least initially. But the real focus for us could come down to, as I said, on growth. How is the U.S. economy holding up with those tariffs? The second thing is, how is the rest of the world holding up?
Yeah. Do you think that tariffs are going to have the same impact on FX, on the dollar, as they did in the previous administration, or the one before, the previous Trump administration? Because presumably through time, we start to adjust to them. Not that we know what the size and duration of the tariffs is going to be, because we're going to have to wait, right?
I mean, at least in the first administration, because it was almost the shock and awe was greater, and we've been going through the scenarios and the narrative about tariffs being imposed this time around for quite a lengthy period. So we can't conclude that it's in the price, but the mental exercise has been ongoing, I'm sure, for many. But I still think that there would be an impact where the dollar would likely rise. But the duration of it is open to debate, because the markets start to get more concerned about U.S. growth, then that could change the dynamics of the dollar and what it could mean versus many other currencies.
Can we just move on to Asia, seeing as we're sitting here in Hong Kong, but also because it just seems that we could be remiss here in one of the biggest developments. Is it possible that China has turned, that we've got past the worst? And what about Japan?
So in the context of the currency again, the renminbi side of the equation, we all know that it's been incredibly stable over the last few months. When there's been some optimism around what the Chinese authorities are doing on fiscal and growth initiatives. On the other hand, there's been some hesitations too because of the external tensions through the trade channel. But it still seems that the currency is in a state of stability that may not last. It could be tested, just like many others, in the coming months if U.S. tariffs actually start to become more problematic. Of course, the opposite will also hold true. If those don't really materialize as a significant downward pressure on the currency, then stability would continue. But the baseline is probably some modest depreciation is likely.
Yeah.
But what about for you in terms of bond yields?
Well, it seems that the bond yields may have found some kind of floor. It's tricky. The momentum last year, and momentum, that's a word that we should explore some more, because much of the positioning was about momentum. But Chinese yields were heading towards 1% last year. Now it looks like maybe we've turned. Things can't really go that much further. And I think it's interesting for Japan as well, because look, if you told me a year ago that we'd have Japanese bond yields at this level, I would have been very surprised. In fact, again, maybe we're getting towards the highest point for Japanese yields. Just as Japan's hitting the top, maybe China's hitting the bottom.
But this is where you can also have a disconnect between the currency market and the fixed income market, because higher JGB yields have not translated into a meaningful, stronger Japanese yen.
Yeah.
So it doesn't always go according to plan.
Well, this is what's interesting, and it's cause and effect, and this is where we've got this healthy tension between the bond market and FX, and sometimes we can have completely different views. It doesn't seem to matter, right? Because it depends on the time horizon, it depends on the context, and but it is true that maybe the Bank of Japan were hiking rates because the yen was so weak. And that may not be a factor going forward, right?
Well, I often reference the last hiking cycle by the Bank of Japan, which was in mid-2006 to early 2007. And what had happened back then with the currency is actually it went down. It didn't go up, even though that the Federal Reserve had its policy rate unchanged, and we're becoming increasingly concerned about the U.S. housing market problems. But the dollar strengthened versus the Japanese yen.
Yeah.
In terms of things to look out for the next couple of quarters, surprises, risks, what's on your potential radar?
Look, we try and think through these markets in terms of scenarios, and that word stagflation keeps coming back in. I think technically it's very difficult to see it happening. That means you get consecutive quarters of negative growth and accelerating inflation. That's probably unlikely, but we always have that. There's always a scenario whereby things don't quite go to plan, and somehow there's a policy error, and from the central bank perspective, particularly in the US, if inflation really was taking off, then they've got a problem and the bond market's got a problem. I ultimately think that yields are coming down because they have to, and it's really it's about the budget. It's about what the US can afford. And I think it is as simple as that. But in terms of surprises, I think we have to be. I think the reason the Fed is being so cautious is because there is always that chance that inflation will take off again. But again, it's not our baseline, Paul. Look, Paul, thank you very much. It was nice to have the conversation.
Thank you, Steve.
Thank you for joining us for this episode of Perspectives. Make sure you're subscribed to HSBC Global Viewpoint to stay connected